Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Japanese GDP growth up 0.4%, 1.6% for the year. It's a good number, and it comes on top of steady progression from 2 quarters ago being in contraction by 0.3%, then zero growth, then 0.4% growth. So there's a steady progression there. It might be a little bit too much to expect that steady progression can just be extrapolated, but at least we're seeing stabilization of the Japanese economy. Ongoing stabilization does not mean booming economic growth where you can raise interest rates. Really, that is the story there. So I would suggest to you that any market sentiment swinging in the direction of this GDP number means the Bank of Japan will be raising interest rates is probably mistaken. If anything, of course, the Bank of Japan is going to maintain a slightly tightening bias or outlook or rhetoric, but do not expect any significant interest rate increases in Japan for the rest of this year. Inflation remains firm but under control, and really Japan wants to get itself out of 1-2 decades of rather flat economic performance, so it's not going to be in a hurry to hit itself on the head with interest rate hikes as is happening in the United States and Europe. For the US equity market, of course, the big developing story, ongoing story, is the US debt ceiling crisis. Will there be a US debt default or not? Every day the pendulum swings a little bit, but the pendulum only swings back and forth around uncertainty. So uncertainty remains the principal play there. Of course, it is more likely than not, but the problem is how possible the unlikely is. It is more likely than not that an agreement will be reached on the debt ceiling in the coming 5 to 7 days, perhaps 10 days. That being said, it's not beyond the realms of possibility that the debt ceiling negotiations will not be concluded by the 1st of June, but somehow the government will keep going till the 3rd, 4th, 5th of June. I think that is a possible scenario as well, but not one that equity markets or markets in general would be happy with. So I see the potential here for a resolution, which means what happens then? We get a market response. We get a favorable market response, a relief rally in the true sense of the word. And we know that from recent history, equity market rallies can become a little bit self-fulfilling to an extreme level. So that's something to bear in mind. However, I do see the ongoing fundamentals as being absolutely dire for the United States. Retail sales disappointed. They were up, but they disappointed. There's a lot else going wrong with the US economy at the moment. I don't see any real respite to the economic slowing that is occurring in the US or in fact around the world. China, everyone's gone, sort of boom theories, bust theories, boom theories, bust theories. I've just been the same the whole way through, and it's been a very accurate forecast that China is not going to have the previous boom rates of growth, but it is going to have steady rates of growth. So it's a stable, growing, second largest economy in the world, and on some criteria it's even already the largest economy in the world, but let's just still call it, so we don't offend too many people who still call it the second largest economy in the world. And it's going to be growing at 2 to 5% worst case, probably 3 to 6% best case. So, in those kinds of numbers are what we're going to see for China over the coming decade, more likely the 2 to 5% range, I think. And that's good for the world. It's a stable anchor in a sea of uncertainty. And as much as people want to create the hype about when there's good economic data or the worries about when there's disappointing economic data, it's still very strong and still growing from a much higher base that more quickly achieved than any other country in the history of the world. So expect that to be maintained. Once the debt ceiling crisis is out of the way, I do think equity markets, bond markets could again be vulnerable. So I'm assuming the best case there. If that's the most likely, but that unlikely is such a big chance at the moment, it has to be looked at. And so if there is a US default, you're going to see bond prices drastically relocate downwards. I would call it a permanent relocation down in price for higher yield. And that impact will be felt around the world among most economies in terms of their own bond pricing and in terms of business sentiment, I would think. So there are global repercussions, and the whole world is watching because of that. Also, equity markets would probably begin a slide that would be very difficult to arrest. So we could see weeks or months of downward equity market pressure from a default, even if the default is resolved within days, because it's just not a very reassuring state of affairs to the world that the world's largest economy, we're still calling it that, is slowing, at best is going to have flat economic below trend performance, still has high inflation, and please be aware, I fully expect risks are growing that there will be no Fed pause. And even if there is a Fed pause, the next movement after that will again be to hike rates, because inflation is very resilient. Can I just put something out there? Really put this in your back pocket to consider in your trading going forward this month. And of course, I could be wrong, but I have a feeling, an inkling, that the coming CPI and inflation data in the US for this month that we will have yet to see will ring alarm bells at the Federal Reserve. I think it could surprise the market just how strong inflation is remaining in the United States and to some degree around the world. So definitely still in a tightening bias at the very least, if not another Fed rate hike at the next 1, 2, or 3 meetings, which is very much against market sentiment, very much against market pricing, and therefore could be an opportunity to keep an eye out for. Of course, in back of all of this, gold looks very strong. Gold's getting sold down now because there are an enormous amount of global stop loss orders below 2,000 after it managed to sustain itself above there, and there have been 2 buying spikes from near the 2,000 level, which gave people a lot of confidence to put their stops under that level. The market's gone for those levels. I call this a technical correction, but also gold can come under pressure should the debt ceiling be resolved. So watch for, there is chance for some gold weakness there, but medium to long term, very firm buyer of gold. Think we'll see 2,300, 2,500 this year. I don't think we'll see 3,000 unless there's a US default. So for the moment, gold could be under pressure as a resolution of the debt ceiling crisis is anticipated. But once that is out of the way, I think there are other reasons to be buying the shiny metal, and it should still continue to perform well through the rest of 2023. In fact, 2,300 in 23 is my next target. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.